Trump seems to be a force to be reckoned with. He seems to have a way of getting what he wants. We saw him at Davos a few weeks ago go around and making deals with everybody, and maybe his tactics are somewhat questionable to some. However, he seems to sort of get his way. Now, he's openly been saying he wants rates lower. He's been saying he wants rates down, maybe down to 1%. Right? He's told the Fed nominees to, promise rate cuts or you don't get the job, kind of a thing. Can Trump actually force rates down? I don't want to use the word force. Do you think Trump could get rates down to 1% before the end of his term?
Oh, I think if you've had a big war and we had a huge stock market crash, yeah, it would be at 1%, but I don't think he wants it that way. So I think the president has more influence on interest rate policy than the market understands. The Fed is basically just a group of people, political appointees, and um, they're not popularly elected. They don't have their own army. And so we've seen the president squeeze Governor Cook, squeeze Fed Chair Powell, and I'm sure that he's squeezing other people behind the scenes as well. I'll just give a little bit broader context here. So for most of history, for most countries, the central bank is part of the government. Like it does what the government says. In Japan, for example, the Bank of Japan basically did whatever the government did, supported its industrial policies, and contributed to a big boom in the 1980s. And then they did not become independent until 1998. In the UK, again, first world country, had been doing very well for hundreds of years. Their central bank did not become independent until, I believe, 1997, and in France, somewhere in the early 1990s. So it's actually a historical norm to have the government have more influence over what a central bank does. It's basically just a different economic model, more of a coherent industrial policy model where the government has a goal. Oh, let's say for this case, for example, we want to have a remanufacturing renaissance. We want to reindustrialize. We are facing an existential competition with China. And so we need everyone on board to try to support this effort. And that means lower rates. I think that's the economic model that we're moving towards. It's actually the same as the current model in China, for example, where they do not have independent central bank. The central bank does whatever the government says, and the government, of course, does whatever the Politburo determines through their plans and so forth. So it's just a different economic model. I think that's where we're heading towards.
Okay.
I think that we will get lower rates. I think that's probably a large, significant mispricing in the
So
market.
do you think the 1% number is probably how Trump does like anchoring, like throwing out crazy numbers to
Yeah,
settle
yeah.
down? So he doesn't really want 1%. He wants them much lower. We don't really know where that number is. He probably gets them much lower, but maybe not to actual 1%.
Yeah, well, I mean, we still don't have Greenland, right? Uh,
Yeah.
so we have some bases on Greenland, better access this time. So I think that 1% is definitely not going to happen. But here's the thing about central banking: it's not a science; it's an art, right? So I'll give you an example. So let's say that you want your central bank official and you want lower rates. How do you go and convince people to do this? There's a lot of ways you could actually do this, right? For example, what people commonly do right now is you're like, the unemployment rate, we are a dual mandate central bank, full employment, price stability. I'm really concerned about employment because, the employment numbers aren't great. Unemployment rate is trending higher. All these anecdotal reports about, layoffs. We got to cut rates. Or let's say that you're looking at inflation. It's definitely above target. It's been above target for 5 years. But hey, according to my calculations, a lot of the inflation today, it's just tariffs. And we know tariffs are temporary. So inflation is transitory, which is what some people say. And a lot of people use the word transitory during
Yeah.
22 and 2021. Another way you could do this is that, I think that we're super restrictive right now and we should just moderate our stance a little bit. So maybe if we cut rates by 25, 50 basis points, we'll just be less restrictive, right? We're still being restrictive, getting inflation down, just a little bit less restrictive to balance out employment concerns. So there's a lot of wiggle room to actually get an outcome. It's an art, and really, because it's an art, a personnel just sets the policy. So you can easily have a central bank that can go say cut rates 4 times this year, get it to 2.5, maybe 2.25. I think that is totally reasonable. To get to 1% by the end of the year, I think that
Well, I
is
wasn't saying by the end
very,
of
very
to be fair, I wasn't
difficult.
saying by the end of the
Oh,
year.
yeah.
I was saying by
Yeah.
2029.
Oh, oh, that's a
I
long
said by the
time.
end of his term. By the end of his term.
Yeah, yeah, but I have no idea. I mean, anything could happen. But I'm just looking at this
Right.
year in my
Yeah.
context. But I think we can get 4 cuts this year. Uh, the president, I think he is actually demanding 1%, not when he leaves, but right now, before the
Yeah.
election, preferably,
Yeah.
right? So I think he's not going to get that, but he's going to get more than what the market is pricing, which is just 2 cuts
Yeah.
this year.
I mean, the interest rates is, like you said, there's an art to it, and it's accommodated for a whole bunch of different reasons. And some of these reasons maybe compete with each other, but one of which seems to be a massive reason, which is the interest on the debt. And the interest on the debt is one of our, I believe, our top three expenses that we have right now, pushing us into this fiscal dominance period. And that seems like a very good reason to get rates down, if nothing else. Wouldn't that be one of the primary drivers?
It can be, but I have not heard Chair Warsh ever talk about interest rates in that sense. It could be something he whispers, just not to scare the public. But uh, I think so. To your point, right now the federal interest expense is about a trillion or $1.1 trillion annually. It's expected to continue to increase. We just had the latest CBO estimates come out today, Wednesday, and so it looks like it's going to be an even bigger part. Now the Fed makes it worse because as it keeps interest rates higher, how does the federal government pay its interest expense? It just keeps borrowing
Right.
more. So you kind of have that compounding effect. Here's the interesting thing, though. So people like Warren Mosler have been talking about this for some time, and that is when the federal government pays interest, it's basically interest income to someone in the private sector, right? So you end up in a position where, when you hike up interest rates, thinking that you're slowing the economy, you are also increasing the interest income of whoever bought treasuries or whoever lent out money. And so you may end up in a position where your higher interest rates actually stimulate the economy on net rather than slow it down. So you are in the head, you're getting to this perverse place where you're not actually sure what interest rates do to the overall economy. I don't think they'll cut it because they want to make the debt expense go lower. Honestly, when I look at Congress, I don't get the sense that anyone there cares about the fiscal deficit. So I don't think that's why they do it. But in the future, you could end up in a position where the stock of debt is so large that when they want to actually maybe reduce uh, the stimulative impact of the interest expense, they might actually have to reduce interest rates a little bit.
Hey, if you like this short conversation I just had, you're going to love the full length conversation. Don't miss it. You can go ahead and click right over here, and I'll see you over there.